Hello, everyone, and welcome to Yahoo Finance. I'm Dave Briggs, along with Jared Blickery. A not-so-happy Friday, at least on the markets. Let's get you up to speed now on Friday's market action. Thursday saw the worst day for the Dow in 3 months, and the pain, it appears, will run into the weekend. A broad-based sell-off today. As you can see, let's check out the numbers. The Dow dropping more than 1%, 348 points at the moment. Still an hour to go before trading. The S&P dropping 1.25%. The Nasdaq also down well over 1%. We are a week away from Christmas, but it appears investors may not be seeing Santa, Jared Blickery.
That is right. And you mentioned Wednesday. That was a bad day for the markets, and that kind of set the tone for the rest of the week. And in fact, that's why I'm seeing where a lot of the losses are centered around us. Some of those stocks and some of those markets, including crypto, that showed cracks on Wednesday. Here's what we're seeing today. You can see all the major markets plus the Russell 2000 trading under or just under $1 or a percentage point off. But here is the S&P 500 futures for the week. Let me change this to a line chart so we can see a little bit better. Just wanted to show you this spike here. That wasn't the Fed announcement. That was the CPI announcement that we got before the bell on Tuesday. This was the actual Fed announcement, and it was downhill ever from there. So let's check out the sector action that we have going on. And we can see today, everything in the red. Real estate down 3.4%, the worst day in a number of weeks for real estate, but also consumer discretionary and utilities, healthcare, all down about 1.5% or more. Communication services, the least worst off, down 12 basis points, and it has been getting hit hard this week. Just want to show you the 5-day price action. Energy, the only stock or the only sector in the green, and then consumer discretionary, that is down 4%, followed by communication services, that's 3%. But just looking inside the Nasdaq, this is again over 5 days. You can see lots of red and dark red. Tesla, we're going to be talking a lot about that, down 15%, Dave.
Sure is strange to see Apple down about 5.5%. No real news driving it down other than the broader sell-off. All right, let's get you up to speed now on the Fed. A few Fed bank presidents are speaking today, and Jen Schomburger has the details for us. Jen, what are we hearing?
Hey there, Dave. Good afternoon. San Francisco Fed President Mary Daly says she's not convinced on signs inflation may be cooling yet and says we've got a ways to go. Speaking virtually at the American Enterprise Institute this afternoon, Daly says the key to bringing down inflation is rebalancing the labor market in order to bring wage growth down. Take a listen.
The labor market remains quite out of balance. We have too many jobs and too few workers. So that means that wage inflation is going to be above its long-run sustainable average, and we're going to have that passing through to prices. And that's what we're working on right now. That's why my projection has gone up.
Daly, like other Fed officials, says she thinks the unemployment rate will need to rise to about 4.5% or slightly higher to restore balance in the job market. She says wage growth is still running around 4.5% to 5% and needs to come back down to 3.5% to 4%. Daly says that means higher rates held longer. When asked whether holding rates at high levels for some time, as Fed Chair Powell has said, means 11 months, as has been the case historically, Daly called that reasonable, but said that the data will determine that. Now, elsewhere, New York Fed President John Williams told Bloomberg Friday it remains possible the Fed raises interest rates more than it currently expects next year, adding that he's not expecting the economy to fall into recession. Now, officials have penciled in estimates for rates to peak around 5.1% next year. Of course, they have repeatedly revised higher their estimates for rates every single SEP we've gotten this year, and Powell did not rule that happening again at the March meeting next year. Back to you.
All right, we got to leave it there, but a big week for you. Looking great down there, by the way, Jen, down at that FOMC meeting. Thanks again for that report. Now, we want to stick with the markets and bring in Christina Hooper. She is the Invesco Chief Global Market Strategist. And Christina, always great to see you, and thank you for showing your face here on a Friday afternoon where I began by talking about the Fed. Has it all been about the Fed this week? Just wondering if there's anything else on the radar and what might be coming in the weeks ahead, as most people have their heads filled with visions of sugar plum, something like that.
Well, Jared, it's been a 1-2 punch. It's been about the Fed and then some weaker economic data. And that has created a picture of a Fed that is being ruthless about inflation and perhaps careless about the economy, not recognizing in particular how much impact, how much damage what it's done thus far has already had on the economy. I think retail sales really spooked markets yesterday, and we've seen more data since then. And so the general concern is that we're headed for a recession based on what the Fed has already done. And on top of that, the Fed seems poised to do more. Now, the silver lining is I think the Fed is talking tough, but I do believe that it will hit the pause button if it feels more comfortable about inflation, and certainly if it feels as though it is sending the U.S. economy into some kind of traumatic decline.
Nice to see you, Christina. I love some of the language you use in your notes. So I'm just going to imagine I'm eating popcorn as you describe why this market dynamic is like a typical horror movie fake out.
Yes. Well, what investors are concerned about, market participants are concerned about, is that inflation is going to rear its ugly head. I think there's some uncertainty on the part of FOMC participants that Jason Voorhees will get up again, as we've seen tons of times in tons of movies. And so I think that fear is there, and it's born out of reality. Recall back in the 70s, the Fed thought it had killed inflation, only to see it come back up stronger. And so that is certainly the frame of reference they're using as they talk tough and act tough.
Hey, Christina, I want to talk to you about the bond and the currency markets. What I noticed Wednesday, which was interesting, still sticking with the Fed here, was that even though it seemed like the market in terms of equities was taking Jerome Powell's hawkish rhetoric at face value, finally, maybe at least for a few hours, though, the dollar didn't really move that much. Wondering if that means anything to you. And then just in general, what is the bond market signaling with everything we've been talking about with the Fed and whatnot?
Well, I think that what we're seeing is currencies and certainly the bond market being less reactionary to Fed talk, certainly less reactionary to the FOMC meeting, and is looking ahead. It's certainly suggesting that inflation is more tame than what many fear, just given past history and certainly what the Fed seems focused on. And I think that should be comforting to investors. Certainly, we should hear tough talk because the Fed doesn't want financial conditions to loosen at this point. It wants to get the job done. And part of that is talking down markets.
Yeah, it's interesting because Jen Schonberger had some Fed speak today, and Mary Daly also said she doesn't know why markets are so optimistic about inflation. Of course, that was earlier today before another sell-off. Are markets beginning to listen, though, on inflation?
Markets are certainly, I think the stock market is listening about inflation and is reacting. And I think that's likely to continue, at least in the near term. But there is going to be a tug of war, a push and pull almost on a daily basis because we are getting closer to a Fed pause. And the reality is, once a Fed pause is imminent, I think we're going to see stocks err on the side of a gravitational pull upward.
All right, Christina, and notwithstanding whatever fluctuations we may see in the next couple of weeks, let's think about the big picture next year, 2023. Any themes that you're seeing emerging, and how are you positioning yourself and your clients for the big change of years here?
So, Jared, this might be boring, but it really is a road to normal. It is going to be a bumpy road to normal. But normal is better than what we've seen. We've seen an extraordinary year for inflation, and not in a good way. We've seen an extraordinary year for central bank policy, and again, not in a good way. And we've seen an extraordinary year for asset class performance, and not in a good way. So next year, I think we are going to be on a road to normal. It's not going to be easy. It's not going to be smooth. But I think what we're likely to see is more normalized asset class returns, more normalized central bank activity, right? Rate hikes of 25 basis points as opposed to these jumbo 75 basis point rate hikes. And of course, inflation moving to normal. It's not going to get there. It's not going to reach the Fed's target in 2023, but it's certainly going to look better. It's going to moderate over the course of the year.
Not going to be easy. Invesco's Christina Hooper, always great to have you. Enjoy the weekend. Thanks so much.
Thank you.
All right, we're just getting started here on Yahoo Finance Live. Coming up, Elon Musk banning several journalists from Twitter. We'll talk about what's next for the platform. We'll also speak with the Tesla analyst who says, quote, the nightmare of Musk owning Twitter has been an episode out of the twilight zone. And Goldman Sachs reportedly plans to lay off as many as 4,000 employees. We have the details. Don't go away. Elon Musk's commitment to free speech apparently does not apply to journalists. Twitter suspending the accounts of CNN's Danny O'Sullivan, the New York Times' Ryan Mack, the Washington Post' Drew Harwell, and several others. Elon then popped into a Twitter Spaces with some of the very journalists he'd just banned. Listen to what happened next.
I have to ask, I think what everyone's wondering is it's highly unusual for journalists at the Washington Post and the New York Times to have their Twitter accounts suspended. And it just so happens that it's, the boss in charge, so, what's the deal there? Oh, I think Elon has left.
That was the voice of Katie Notopoulos, BuzzFeed News senior technology reporter. Katie, awesome to have you here on this Friday. So Elon suspended Spaces after your chat. We've got a lot more substantive conversation here to follow. But first, I just have to get your reaction when suddenly Elon Musk pops into your Spaces and starts talking.
I was a little surprised that he showed up, but one of the people who is, as you mentioned, not a Twitter employee, but Jason Calacanis, who works closely with Elon Musk and has been helping him as an advisor on Twitter. He was in the space, sort of arguing with some people in there. So I suspected that probably Elon found out about it through his friend. It was a little bit surprising. Elon is he tweets a lot about what he is doing. So, he's not a closed book. And ultimately what he sort of said was essentially the same as what he had tweeted, which is that he had suspended these journalists based on doxing rules.
And I'm just looking at some of the reports here, absolutely incredible. Some of the journalists in the room with you there who were given the ability to speak, even though their accounts had been suspended, they were just talking and they had been reporting on this account that on reporting that Elon Jet had already done. Its account was suspended, as I understood. Links were provided in articles to the suspended account or the deleted or I guess unavailable tweets. But I'm just wondering, any substance to the argument that these other journalists were somehow doxing Elon Musk and the location of him and his family?
I think Elon certainly has a very strong opinion about that they were indeed in violation of the doxing rules that he had just made up hours earlier. And it does sound like he had a sort of frightening incident that clearly, he really took to heart all of a sudden a new vigor about wanting to enforce moderation rules. However, he did earlier in this space when he was sort of asked about, well, okay, we sort of understand why you banned the account that tweeted the locations, but why did you ban the journalists who were just reporting on the account that tweeted your locations? And he was sort of insisting that this was an attempt for them to do ban evasion, and that posting a link to the now deleted stuff through links in their reporting was somehow their tricky version of ban evasion, and that they were attempting to sort of use their journalist status to skirt the rules, which I think is not totally a compelling argument, but he felt very certain about it. And it appears that was sort of the logic, that even linking to the old account in other ways was akin to doxing.
Katie, as you see it, real reason, why were these people banned?
Oh, well, he didn't. I think the real reason is that they had tweeted something in relation to the Elon jet, but it just so happened, many people tweeted about the Elon jet. There was a whole news cycle, for the last couple of weeks about this account. And it just so happens that the people that he did ban happened to be people who were at big news publications who had also written critically about Twitter and Musk in the past. And so, not even in the very recent past, even earlier, probably that day. I think that's where a lot of eyebrows were raised. That was this a personal vendetta against some journalists that he didn't like, and he kind of came up with this half-baked excuse that it was related to the jet account? Or was he just so shaken by some incident at the airport that he said, I don't care if these rules don't really make sense, I'm going to just go ahead and ban anyone?
We got less than a minute left here. Give you the floor. Any last words you want to impart on this conversation here we're having?
I think that ultimately, it's a very chilling effect that he's created here. The banning journalists for reporting and posting news gathering information, posting articles, that's pretty clearly of some concern. And I think that it's hard to know what this means for the future of Twitter. I think that really has soured a lot of people on what the future of Twitter is going to look like. At
the heart of this, what do you think Elon Musk's definition of free speech is?
I think he's learning the hard way that the answer to that is not so easy. And he's kind of doing this speed run through all the steps of moderation that Twitter had been doing over the past 10 years, learning that, hey, you can't just say it's a free for all, do whatever you want as long as it's not illegal, because there are actually things that maybe aren't illegal, but they cut a little close. Maybe they're a little bit dangerous. You do have to protect vulnerable people from abuse and harassment and threats. And sometimes that means deleting accounts. Sometimes it means taking down tweets in things that don't exactly feel like, free speech for everyone. So it does feel like he's learning from, the very bottom of the baby steps, how to do moderation. And unfortunately, he didn't take over a already mature content moderation system that was left in place for him. In fact, he got rid of that and he's recreating it from scratch.
I like that, stressing moderation, something my grandfather was very in support of his entire life, but with here, a different definition. Katie Antopoulos, always appreciate you stopping by, and thanks for that report. Coming up, Tesla investors getting antsy after Elon Musk sells more than $3 billion worth of stock in the EV giant this week. We're going to speak to an analyst who has much to say about those sales up next. Tesla shares under a little bit of pressure today as Elon Musk's recent stock sale and his focus on Twitter weighing on the stock. Joining us now to discuss is Wedbush Securities Senior Analyst for Equities, Dan Ives. Dan, always great to see you here. Just got to ask you about these stock sales. Anything hinky going on here? Because my understanding is if you have a corporate executive who's laid out a plan for selling a stock and it's supposed to be arm's length, the timing should not be theoretically suspect as it is in this case. Maybe you can clue us in on some of the details here.
Look, I mean, the biggest problem is, Musk is essentially using Tesla as his own ATM machine. And, obviously with the Twitter circus show that continues to, I'd say, get worse, not better, the red ink at Twitter means he's ultimately going to have to sell more stock. And it becomes just, a cascading spiderweb situation that's just cast a massive shadow on Tesla because of the antics we're seeing with Twitter and Musk, where, I mean, this is almost a Twilight Zone episode that never ends.
What has been the impact of his losing his focus? Down 30% shares just since he took over Twitter, down 62% year to date, down 14% this week. What has been the impact of the Twitter distraction?
I mean, look, Musk, it's been a magic carpet ride the last, I'd say 3.5, 4 years. I mean, they really at the top, not just of the EV race, but even from a brand perspective, from a Wall Street view, I think changed dramatically. Now he's essentially gone from a superhero to a villain in the eyes of many investors, because of what we see on Twitter and the impact that that's had on Tesla. Feels like attention continues to be focused on Twitter. And the biggest problem, selling Tesla shares to fund Twitter. And even, what we've seen over the last week, it's brand deterioration, a black eye for Musk, which is a black eye for Tesla. And that's part of the problem here. It was always our biggest fear once he bought Twitter.
Well, Dan, is there anything that Elon can do to quell some of these, maybe get ahead of some of the controversy? Not that he's been historically known for doing exactly that, but it just seems to me like if you were to change his 12B1 plan, I believe that's what it's called, or just acted, I just maybe gave investors a heads up. That's another potential solution here. Anything Elon could do to kind of mitigate some of these claims against him?
Yeah, I mean, look, you hit the nail on the head. I think first off, needs like a lot of CEOs a defined selling plan in terms of what he's going to sell, per quarter. And I think investors need to know that. So there's no surprise, because right now it's a guessing game, and that actually becomes just fuel for the shorts, because you continue to worry about it. And it's been the boy that cried wolf, saying that he's done selling, but yet continues to sell. Two, you need a CEO of Twitter that's not Musk. I mean, this is what I'd say is an untenable situation in terms of him being CEO of Twitter and Tesla. And it comes down to, 44 billion, again, it's going to go down in our opinion, is probably the most overpaid tech acquisition in the history of deal making, but it's the impact that it's having on Tesla. So I think you need separation there. And then look, in terms of just for Musk, it's attention. You need more and more to focus on Tesla and not just sitting there on Twitter, because I think that's been a bad look, and I think it's reflected in the stock.
And you still have an outperforming at $250 price target on Tesla. Why?
I mean, look, it's the fundamental view. I mean, I believe it's one of the most transformational companies over the next 5-6 years, along with Apple. And that's why it's a fundamental bullish view. But no doubt, I mean, I think the clock struck 12 in terms of patience wearing thin. And I think that's what you start to see with a capitulation in Tesla in a risk-off market. And I think it's just really been, I think for investors, it's really a Ted Stryker airplane moment in terms of the view of Musk now.
Striker. I'm looking at a chart of Apple here, and it looks like I got 4 pretty big red candles in a row here. Something that's a little bit unusual for a stock, as Dave was remarking earlier, when there's really not a lot of news out. And it looks like, at least on a technical level, bumping down against that 130 potential support area. Looks like things are getting dicey potentially for Apple. Just wondering how you're viewing this as a securities analyst that you cover.
Well, I mean, obviously, look, technicals are dictating some of that now, but everyone knows, and we've talked about a lot. I mean, given the supply chain issues in China with the lockdown, they're probably going to come up, potentially on the high end, 10 million units short, on the low end called 7 million. It's not a demand issue, it's a supply issue. I mean, demand still outweighs supply, I think 3-to-1, which is bullish. But I just think right now in a tech risk-off market, Apple's going to have a bullseye on their back, especially given what we see with the COVID lockdowns, but we don't view this as a time to panic. I view this as just a way oversold Rock of Gibraltar name that I think is massively higher over the next year. That's why we have a $200 price target.
And stepping back to Elon Musk and stepping out of your analyst role for just a minute, I mean, are you concerned about the human being that is Elon Musk, that seems to be in these minute-to-minute overreactions, Twitter memes, banning journalists?
Look, it's a concern because I think from the beginning, this was always the worry that if he actually owned Twitter, things like we saw last night, today could ultimately happen. And it goes back to that whole freedom of speech, which actually has turned out, you could argue maybe it'd be the opposite in terms of what we're seeing. And it's about the brand of Musk. Brand of Musk is associated with the brand of Tesla. And look, this is someone that obviously with SpaceX and Tesla, you can never argue with what they've done, historical success. But the double-edged side of Musk, the negative side, is what we see playing out today. And this is no different really than a 5-year-old, getting into an argument, in the playground. But unfortunately, it's on a global platform, and that's the problem.
And you have a buy rating on Penn State in the Rose Bowl?
Oh, yeah, Pasadena bound. I think Penn State by a touchdown over Utah.
Underdogs against the Utes. Dan Ives.
Underdogs.
Good to see you, sir. Enjoy the weekend.
Thanks.
All right, let's talk a little bit more about the cult of personality that is Elon Musk. And look, it's not entirely clear what road he's going to go down. Not going to appoint someone to run Twitter. Not going to appoint another CEO at Tesla. I have more respect for Dan Ives to evaluate that stock. But what's the catalyst to getting that stock, getting that company back on track, getting him back focused? We saw this a lot in strange parallel here with Donald Trump in the White House.
Yes.
Who does he listen to? Who's his lieutenant that can say, focus, I want to get you back on track here? It doesn't appear there's anyone near him that can do that.
I don't think so. And it seems to me like this is a situation that's going to have to be solved by just falling on one's face and getting kicked around a little bit. And that doesn't happen to the richest guy in the world very often. And that's fine. But if you're going to be the CEO of a big public company like Tesla, if you're going to be the CEO of some big private companies like SpaceX and also Twitter, which essentially is a public role for him, I think it's just kind of insane to take on that much responsibility. But to your point, who is he going to leave the keys to the kingdom? I have no idea, because as we were talking about in the pre-meetings here, I think he's fired a lot of his top lieutenants. So
yes, his top lieutenant at Tesla had a controversy. He slid him over to SpaceX, and now it's not entirely clear who that person is or what's going to get any of these companies back on track, although SpaceX does appear to be in good hands with the valuation. I think it was $140 billion this week. So that may end up bailing him out in the end.
Hopefully there's a lot of oversight because of just the nature of what they're doing over there at SpaceX. All right, coming up, Krispy Kreme shares down more than 10% today. We're going to tell you why just after the break.
All right, time now for Triple Play. 3 stocks we're watching in the final 30 minutes of trading. Today we have Meta, Krispy Kreme, and Novavax. I'll start us off. My play is Meta, a rare upgrade going into the holidays. JP Morgan analyst Doug Anmuth saying, quote, heading into 2023, we believe some of these top and bottom line pressures will ease, and most importantly, Meta is showing signs of increasing cost discipline. We believe with more of that to come. Anmuth lifted his rating to overweight, raising his price target from 115 to 150. Meta shares popping on the note, up about 3% on the day. Still a very, very rough ride, though, investors have had to endure this year. Look at that stock chart. One Jared Blickery does not like. Brooke DePalma joining us today to weigh in on this. What do you think about Meta's moving forward?
Yeah, absolutely. Well, it's been quite the year with Sheryl Sandberg stepping down. Certainly a leadership loss there.
Good point.
And so when you look into 2023, you know, it's a question of how they'll exactly recover after losing her and how exactly they'll see a path forward, especially trying to engage younger users who are migrating to TikTok.
Yeah, they probably need a TikTok ban. Like I said with Snap yesterday, start lobbying Capitol Hill.
Not going to happen here.
No, probably
Certainly not going to happen. My play today, though, Krispy Kreme in the red after the donut chain outlined near-term and long-term targets at its Investor Day on Thursday. The company reiterated its 2022 outlook with revenue expected to grow organically 10 to 12%. And by 2026, Krispy Kreme expects its omnichannel to bring in $2.15 billion of revenue. Now, CEO Mike Tattersfield told Yahoo Finance this morning he remains very bullish and is focused on driving the business. But Wall Street certainly not sweetening up to that Investor Day. Year-to-date shares are down nearly 38%. And guys, CEO Mike Tattersfield certainly, you know, ambitious to grow the business internationally, but Wall Street not liking it too much.
It's a little bit difficult here. I'm looking at the Wi-Fi Interactive. I got a multi-day chart here. And if we're just talking about an Investor Day on Thursday, this is measuring from the Wednesday close down 20%. That's kind of a big rejection. Usually Investor Days see the stock up a considerable percentage. They save their announcements specifically for that. Just taking a look at the max chart here, you can see bumping down against support levels it had and look like September, October there. This is a max chart. So these are the absolute lowest levels we have on history here for this particular stock. So not the best technical picture, but we'll have to see if any of these, go.
I just have one comment.
What's that, Dave?
One comment on that stock.
He's certainly sweetening up to the idea of Krispy Kreme here.
It's so good,
So
man.
good.
How do you reconcile that with the stock price, Dave?
I don't care.
Investors want it.
It's so good every time, Jared.
It's sweet. That's what it is.
You go do your play. I'm going to do my thing here.
All right, well, I'm going to talk about Novavax, the most exciting ticker here. Obviously, I was following it yesterday as it plunged to a 2-year low. A feat it's duplicated today. The news, it had to return $112.5 million to the UK government for unused vaccines, and it pledged to raise cash from an offering of both stock and convertible debt at $125 million each. Now, that offering amount is actually a little bit lower today. Novavax sold 6.5 million shares at $10 a piece, and you can see the stock price reflecting that. It actually opened up a little bit below $10 per share, and now it's up a little bit, but you take it into the holistic picture here, you can see, well, this looks like, what do you call those heart monitors?
EKG.
This EKG of a chart is right back down, and it's, biotech, so how fitting is that? Other than that, I don't have a lot of comments here, but I'll tell you, Dave, some of these other vaccine makers might be in the same boat, but I think Novavax was just a little bit too late to the game.
Well, correct me if I'm wrong, they were not an mRNA vaccine, which of
different
course
technology.
The real separator for Novavax against the others, and that really is what held them back ultimately. And speaking of mRNA, Moderna is the ticker symbol. mRNA had been crushing it this week on that skin cancer treatment, and that today just got pummeled as we closed out the market, and they were down 7% today after having a really terrific week. So, yep, you may have a point about the larger
And I understand your point. You care more about the donut than you do the stock price.
Here we are talking about EKGs, and I'm eating a donut.
Apropos.
Wow, Brooke,
Apropos,
thanks for playing with us. Have a good weekend. Coming up, the number of legal immigrants coming to the U.S. is on the decline, and it's having a big impact on the job market. We'll explain why after the break.
Welcome back. Widespread labor shortages are hampering the U.S. economy, and there's data to back it up. Despite the Fed's latest efforts to cool off the red-hot jobs market, there are still more than 10 million positions vacant, with 1.7 opportunities available for each applicant. Now, one explanation economists are providing for the shortage of filled positions is the decline on immigration rates. Adam Ozimek, Economic Innovation Group Chief Economist, he joins us now. And let me just ask you, maybe you could give us a bird's eye view of the situation. This is a problem with immigration, not enough immigrants to fill jobs that we had before the pandemic. Pandemic definitely ratcheted up a lot of those pressures. I'm just wondering where we're situated now as we exit, hopefully, the pandemic.
Sure. I think it's really important to contrast two ideas. One is that lack of immigration is a cause of the labor market shortage, and the other is that more immigration could help alleviate some of the immigration shortages. This is important because immigrants, when they come here, they don't just bring more labor supply and do jobs. They also create more demand. That means they spend money on houses and cars and furniture and all the stuff that's in shortage right now. So it's not as simple as saying that, if all the people who had planned on coming here, who would have otherwise come here, had come, we wouldn't have labor market shortages. But it is the case that because immigrants are so flexible, because they're very geographically mobile and they move towards opportunity, they could help alleviate the acute labor market shortages we have today.
And many economists are citing some rule changes by the Trump administration as the genesis of this current problem. What did the Trump administration do that is still alive and well today, that we're still seeing the impact of?
Yeah, so they did a variety of things to reduce immigration. Some of them, like banning immigrants from certain countries, was very big and transparent, and obviously made the U.S. look like not as great of a destination from that perspective. Other things are more technocratic, like trying to make it harder for skilled workers' spouses to get jobs. Other things are very administratively detailed. So it's a lot of stuff that they did that's taking some time to unwind. And some of it, we just need more funding to help the immigration system work faster and work smoother. Processing times were going up before the pandemic, and they went up a lot more during the pandemic. And that's a matter of providing more funding so that we can get people moving through the system faster.
And Adam, could you break down this issue, I guess, by job type? We have skilled and unskilled laborers here. Of course, there's an H-2B process within the IRS to be able to obtain a skilled worker's exemption to some of the immigration laws here. How does the situation look when we view it through these two different lenses?
Well, there are shortages in a variety of places and across the skill spectrum. So, for example, on the lower skilled side, you would look at areas like warehousing and some goods manufacturing and logistics as places where you've got relatively high labor shortages. On the more skilled side, you do still have healthcare shortages in a lot of places. We lost a lot of workers there, and that's an area where it's sort of like always shortages. So I would say the predominance of the imbalance between supply and demand is on the lower skilled side, but there are areas across the skill spectrum where we can use more immigrants.
What could Congress do to ease this burden? Is there any legislation put forward that would help close this gap?
Well, you mentioned the H-2B. That's a great example of administrative action that was taken. They increased the cap there for 2023, so they are going to be letting in more workers for non-agricultural, lower skilled labor. That will help somewhat. They could go even further there. I would also say that helping to make immigration more flexible can help. So a lot of times it's hard for those on temporary work visas to change employers. That's true of H-2As. It's also true of H-1Bs, the more skilled visas. Letting workers go to where the opportunity is, where the shortages are, not tying them to one employer. Increasing flexibility could be very helpful in addressing some of these acute shortages that we see, and also providing faster, more certain paths to green card. So it's not just about getting workers here. It's about getting them the ability to take whatever job has the highest and best return and where we're seeing the most shortages. So, I would say we should focus both on the temporary work visas and then a faster, more certain path to the green card as well.
Unfortunately, it's become such a political football that both parties retreat to their corner. Hopefully some progress down the road in 23. Adam Ozimek, appreciate you being here. Thanks so much. Coming up, the FTX saga has lawmakers, regulators, and cryptocurrency experts divided over the state of the digital currency ecosystem. We tackle it from all angles next. Well, barring a continued market meltdown, the financial story that promises to persist well into the new year is the FTX collapse, which took a surprise turn this week with the arrest of Sam Bankman-Fried. The congressional hearing examining how it happened went on without SBF and provided, frankly, very few answers. Hearings did, however, pour gasoline on the fire that is the crypto debate. Listen.
For 5 years, I've been trying to ban American investments in crypto. I'm the only member of the House to get an F from the only crypto promoting organization that rates members of Congress. My fear is that we'll view Sam Bankman-Fried as just one big snake in a crypto Garden of Eden. The fact is, crypto is a garden of snakes.
And that Shakespearean-like sonnet from California Congressman Brad Sherman, who later joined us to double down on cryptocurrency.
Why do they want a different currency? Dollar's pretty good. And the answer is the dollar is really bad if you want to engage in tax evasion, sanctions evasion, evade bankruptcy court, which I know Sam Bankman-Fried is focused on now.
So there's one side, but we believe in a little barbell-like balance, so striking back at the snake analogy was the wolf of All Street's host, crypto bro Scott Melker.
Sam Bankman-Fried is a criminal. This is not an indictment of the crypto industry. It has nothing to do with the actual assets or the asset class. It's simply fraud. It's disingenuous to pretend that this is because of crypto.
Okay, but a recent poll showed just 8 8% of Americans have a positive view of cryptocurrencies. For context, even Congress has a 23% favorability. Trust is going to be difficult, if not impossible, to build in the months ahead, and has to start with regulation. That, of course, is going to take years. Meanwhile, the question right in front of us, who's right, who's wrong, the wolf or the snake, actually falls on Dr. J. Jared Blickery. Jared, the fact that FTX was a crypto exchange made this, quote, old-fashioned embezzlement more or less likely. What did crypto have to do with the crime?
I think crypto, by its nature, had a bit to do with the crime. And so this is a small indictment of crypto, but mainly an indictment of also the U.S. and the regulatory system here. So did crypto become a den of snakes or some kind of device which would just attract speculators and also con artists? Yes, it became that. And that's because leverage cannot exist without trust. But the reason that trust existed in the first place was artificial. It had been built up by SBF, claiming that he had the CFTC behind him. The CFTC, which is another regulatory agency, they cover commodities mainly, but they've been vying to cover crypto as well, just as they do with foreign exchange. I see a lot of parallels here. If we didn't have this bifurcated regulatory structure in the U.S. and around the world, you wouldn't have these problems surface. It's when we're testing the limits of them that we run into these problems.
Interesting to see the price of Bitcoin was at 18 just a day or two ago and now below 17. So it sounds like you're siding with the snake analogy over the wolf.
I'm siding with the snake analogy, but it's not an indictment of Bitcoin itself. That's a technicality. We're going to have to live with that.
Got it. All right, coming up, we're counting down to the closing bell on Wall Street. Stay with us here on Yahoo Finance Live.
Welcome back. Let's take a look at some of the biggest movers of the day. Number one on the Yahoo Finance trending tickers list is Maxar Technologies. And this means the space race is on, at least with one satellite imaging company and infrastructure company, by the way. Maxar Technologies just got a $4.1 billion all-cash bid by private equity group Advent Technologies for $3.1 billion, with another $1 billion thrown in by British Columbia Investment Management. Now, this slaps an enterprise value of $6.4 billion on Maxar, Morningstar. The deal hinges on a key 60-day go-shop period, which allows competitors to bid on the deal. Let's take a look at the stock here. You can see, well, this is a 2-day price action. You can see up 115%, pretty dramatic. Take a look at the year to date. Most of that movement has been made today alone. And on a max basis, you can see the turnaround strategy up in place since 2019. Basically pretty nice since then. I'd say they've overcome their 2019 highs. All right, now we want to check out our meme stocks because these have not fared so well today or this week. And specifically, we're looking at a couple of names. Virgin Galactic, let's see if I can find this here, down 3.5%. Now, no news. This is a meme stock play here. They did report early earnings a couple weeks ago, and there has been some news regarding a potential sale that is not panning out. That is not panning out. So the bottom line is Virgin Galactic has been hanging out at or near record lows for some time. And I said it hasn't been a greatest week for some of these stocks. Well, Coinbase, not only because it is a meme stock, but also because of the crypto fallout. That stock also hanging out around a record low. On the max chart, you can see it's down 88% from its initial price there. So, Dave, not the greatest things going on in the crypto universe, but I'll put it this way. I think if we take a look at the overall market action for the week, we can kind of get a handle of what has been going on. So here's a 5-day look at our sector action. As we were covering earlier, only energy in the green for the week. That's up 2.3%. To the downside, it looks like consumer discretionary. That's what this is, XLY. That's down almost 4%, followed by those other two mega cap sectors, communication services and tech. And a lot of those big drops started on Wednesday when Powell dropped some cold water on the markets. Now, let's round out the action with a 5-day look at the Nasdaq 100. Front and center there, Tesla, that's down 16%. Also Apple, we've been talking about that. Both of those stocks with Dan Ives, by the way, and also taking a look at some of these chip stocks. Let's take one more look at those for today. Those got beaten down as well. Kind of a mixed board, but NVIDIA down 2%, AMD down 1.5%. Here's your closing bell, final one of the week here on Yahoo Finance.
There's your closing bell on Wall Street. The sell-off started on Wednesday with the words of Jerome Powell, a 50-point hike. They continued on Thursday with an absolute beating, the Dow's worst day in 3 months. And yes, here is how we finish out the week. Off the lows, but still a pretty rough close to the week with the Dow dropping 280 plus points. The S&P down more than 1%. The Nasdaq also dropping about 1%. A broad-based sell-off to end this week. Let's talk more about it with Ahmad Riesco, Insignio Chief Investment Officer, and Michael Kushma, Morgan Stanley Investment Management CIO of Broad Market Fixed Income. Nice to see you both. Ahmad, let's start with you. What do you make of the last 3 days collectively coming off the words of the Fed chair?
Yeah, we were always a bit skeptical of the rally. We saw it being driven mostly by technical factors like liquidity and positioning. Our view has been that the S&P is going to end the year somewhere between 3,400 and 3,700. And that's because we are projecting a recession, a mild recession, to begin next year. I'm not really sure that a lot of the market drawdown was really due to Powell's comments. I think more than anything, the ECB has been the sort of hawkish surprise that has really driven rates higher in Europe. And I think that's what's putting pressure here on markets, not so much the Fed. The Fed really didn't come out that far from where they had been or where expectations were.
Michael, I want to stick with the Fed here and get your reaction to what Powell was saying the other day, and especially with regard to recession talk, because I was listening to Powell with great contortions try to explain how it might be possible conceivably to end up with a soft landing next year. Is that a possibility?
It's certainly a possibility. I wouldn't say a high probability, but it is possible. The Fed has emphasized that the unemployment rate is too low, the labor markets are too tight to be consistent with the 2% inflation target medium term. So they have to loosen that up by keeping monetary conditions restrictive for some unknown period of time, meaning that we don't know how long it'll take, but we'll keep them there until we get evidence that that is loosening up. On the other hand, I don't think they can predict or forecast a major recession. Otherwise, their policy is too tight. So I think there's a consistency there that weakness in the economy, below trend growth, gently rising inflation, gently falling in inflation over time, gently rising unemployment, I should say. But still, the challenge is that medium term, they did raise their forecast for inflation, as did the ECB, as did most central banks this week. They were more pessimistic about where inflation is going to be in 2 years' time.
Ahmed, are you in line with that new projection from the Fed?
Look, we're always looking forward in the sense that you don't want to really pay attention to what the Fed is saying today. You want to project what they're going to be doing 3, 6, 9 months down the line. We are a bit more confident that inflation is going to be coming down harder. So we were a little bit surprised by the upward revisions with the inflation numbers coming out of the Fed. But listen, the Fed itself, if you take a look at the Fed's communique, they actually had a whole section on the uncertainty over their outlook. So the Fed themselves are telling you that their projections are subject to a higher degree of uncertainty than usual.
And Michael, just want to get your reaction to what's been going on with the dollar, also other currencies as well. One thing I noticed Wednesday was we didn't get a lot of reaction out of the dollar, even though stocks in a lot of risk markets sold off after Powell's statements and after the FOMC announcement was made. We didn't really see currencies fluctuate as much. The dollar has been a big driver, I would say, wagging the dog of a lot of these risk markets that we watch around the world. How are you viewing the U.S. dollar's outsized influence on markets, or maybe it's not outsized anymore?
It's outsized maybe with regard to certain countries and currencies, but not across the board. I think the ECB, as was just mentioned, is out hawking most every other central bank in the world. They were clearly in the vanguard, out front in terms of raising inflation projections and emphasizing that interest rates will be continuing to rise to levels which no one thought possible probably 3 or 4 months ago. On the other hand, they're probably about 6 months behind the Fed. I mean, 6 months ago, no one was predicting the Fed would get to 5%, well, almost no one. And no one was predicting the ECB would go over 3 next year. And now they are. And it's still trending higher. So the euro, I think, is getting increasingly well behaved because it is taking over the mantra of the most hawkish central bank with the biggest inflation problem. And yet the economic situation doesn't seem to be deteriorating that much in Europe. But against other currencies, the dollar is still holding its own, because the Fed, despite falling inflation, is still holding firm to this view that they have to keep raising rates to over 5% next year.
All right, Ahmad, we won't see you before the end of the year, but I know you mentioned 34 and 3,700 for a year-end target, so no Santa's showing up. What about 2023? What are you projecting, and advice to investors?
Yeah, so we're projecting a rather, I guess, flattish market in the sense that definitely not like the returns that we've seen the previous year or in previous years. Right now, we're expecting somewhere between 41 and 4,300 as a year-end target for 2023. What we are advising our clients, though, is to start moving money outside of U.S. equity markets. We find the picture outside of the U.S. much more interesting. We think there's actually a potential right tail risk in terms of upside growth surprises coming in from China. So far, China, and it's not something that's being spoken about much here in the U.S., but China has done a 180 in terms of their COVID policy, stimulus, the amount of liquidity that they're injecting into the economic system, even what they're doing in the technology sector and with the U.S. listings. They've really done a 180. I really think that this year you have to sort of believe them that they are going to try to get to that 5% growth target. And if they are, China will be a source of upside growth risk for the global economy for next year. So we're focusing a lot on the emerging markets. Certain markets there are quite attractive. We're also waiting for Europe to finally get some kind of resolution with their energy crisis and with the war. We think once they do, we think actually the growth prospects are going to be better in Europe than they are in the United States, and the market prospects are going to be better as well, because European assets are right now trading at historical unprecedented discount levels to U.S. equities. All
right, some international opportunity ahead. Ahmad Riesgo and Michael Kushma, thanks so much for being here. Won't see us, so Merry Christmas to both of you. Have a good weekend. Coming up, more layoffs on the horizon. This time, it's Wall Street. Goldman Sachs reportedly looking to lay off thousands of workers. We'll have the details for you next. Where's my...
You've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire.
Heard a lot about that concept of hoarding employees in this environment. That, of course, Fed Chair Jerome Powell after announcing a 50-point hike this week. While Powell singled out the tech industry as the one undergoing layoffs this year, news today that the banking sector might not be far behind. Semaphore reporting that Goldman Sachs is preparing to lay off as many as 4,000 employees, around 8% of its workforce. Liz Hoffman broke that story. She joins us now. Liz, nice to see you. Why now is Goldman Sachs laying off 4,000 employees?
Goldman is a couple of years into this incredibly high stakes transformation, trying to make itself less reliant on trading and investment banking and deal making and into a little bit more of a stable, safer institution. It's not going that well. The short answer is that they massively overhired and overspent trying to build this consumer bank, this Main Street bank that they are largely now retreating from.
I got to ask you here what the fallout is here for the CEO, David DJ Solomon. What is it? DJ Diesel? Is that his name? Okay, DJ Diesel Solomon. All right, here's where I'm going with this. I remember Goldman Sachs back in the day. I'm going back to 2007, 8. This was a company that was reportedly calculating their firm-wide risk to 3 decimal points. They were able to pivot on a dime under their previous CEO, Lloyd Blankfein. I'm just wondering, are there comparisons now, fair or otherwise, to Diesel and the way he's running the business? Are there criticisms of what he's doing here?
I think the comparison is a little bit unfair. Wall Street was a very different place when Lloyd Blankfein was running it back in the day. David has clearly, I think, misjudged how hard it was going to be to build this consumer banking business and how long it would take for those investments to pay off. This is going to be Goldman's second best year by revenue. They're going to make somewhere $45 to $50 billion of revenue. And yet, there seemingly isn't enough to go around. And the short answer is that they spent it. And, it's easy to I think CEOs should be investing. They should be strategic and trying to look around the corner and figure out the next big thing. But at some point, an investment with nothing to show for it is just a loss. And they are eating those now, and it's cutting into their ability to pay people.
Very interesting to hear in your piece, you refer to Goldman Sachs as acting like a tech company. If you could give us a little bit more on that analogy, and what does the next iteration of Goldman begin to act like?
Yeah, the analogy is interesting, right? Because Goldman had never, after the crisis, its stock was trailing peers that were by all accounts like kind of less interesting and profitable, places like Bank of America and JP Morgan that had these big consumer businesses, but not these huge Wall Street profits. And the upshot was that shareholders didn't want that like risky investment bank anymore that was sometimes making a ton of money, but sometimes losing a ton of money. And it was very risky and hard to value and a headache to have in your portfolio. And so Goldman tried to become more like a universal bank. And the white space for them, they obviously have a large investment bank, best on the street, a very large asset management firm, and then white space was Main Street banking, and so they tried to fill out their portfolio and build that and become a little more balanced because shareholders wanted them to. So the comparison to tech is an interesting one because for a long time, venture capitalists, technology shareholders wanted their companies to grow. Don't worry about making money, just get bigger. And the incentives were exactly the same. The path was a little bit different. But the truth is that there's a lot of pressure to go where your shareholders want you to go and where you're going to get rewarded for it in the stock price.
Well, Liz, let me ask you here, is Goldman thinking about getting out of the consumer business altogether? Because there are a couple different facets to that. It's not just loans, it's also deposits that would take on as liabilities from customers, and of course that helps their balance sheet. To what degree are they thinking of just saying, all right, we tried it with the consumer and we don't necessarily want to do this anymore?
You have to remember where this started. Coming out of the financial crisis, Goldman's main problem was that its funding was bad. It was funding itself overnight and investing in long-term stuff, securities and real estate. And the best funding out there, no matter who you are, is consumer deposits. They're incredibly sticky. You can pay up a little bit to get them, and they were massively cheaper than the overnight securities-backed funding that Goldman had been relying on. So they went out in 2015 and they bought General Electric's old sort of online deposit-taking platform. And they started raking in deposits because they were paying pretty high interest rates at a time when, your checking account at Bank of America was yielding 2 basis points. But then the problem became, well, how do you wed those customers to the firm? Because if you're just out looking for the highest rate, you'll go to wherever the highest rate is. You don't really think of yourself as a customer of Goldman Sachs. So then they built this lending platform on the side of it that would do 2 things. It would try to make people feel like they actually were clients of the firm and would stick around. And then 2 was a place that you could deploy those deposits they were taking into these loans. And it would be a nice income business. Investors would love it. And then they just got more ambitious from there, frankly. They got the Apple credit card, which again, by all counts, is a pretty good product. Will eventually start making money for Goldman. But again, most people who have that don't think they're customers of Goldman Sachs. They think they're customers of Apple because that's the logo on the front of the card. So they tried to, I think, really kind of duct tape together a bunch of products that might be considered like a primary banking suite. And they didn't really, and they are massively walking back from that. They'll keep the deposits. They will probably run the loan book off or lower over time. But then they carved out that what has started as that Apple Card business, and they now have the General Motors card and some other point of sale financing, which they're calling platform solutions, which is, the way to think about it is that they tried to go directly to the consumer to have a virtual branch. It didn't work. But the one thing Goldman really does have is incredibly good relationships with corporates. So they're going to sell those through their corporate clients.
Interesting. Liz, we haven't talked about Elon in like 15 or 20 minutes. So I got to bring it back up. Apparently a scoop from Semaphore that you are quoted on. Elon's team looking for new investors and other news. What's the latest on the Twitter dumpster fire?
Yeah, so my colleague Reed Albergati and I just put out a story right before I hopped on the air that they're looking for new equity investors into Twitter, offering them the same terms that Elon bought the company on in October. So this would be, you can come in, we'll sell you equity at $54.20 a share. They're trying to close by the end of the year. Look, my read on this is that Twitter has a lot of debt, and it's very unclear that they're going to be able to make the payments. So they're trying to get more equity into it, which will lower the debt burden. Elon himself sold about $3.5 billion worth of Tesla stock this week. Presumably some of that will go to help stabilize Twitter. But this is a very precarious position for Twitter. They're in a ton of debt. Advertisers are fleeing the platform. They're starting to the product is starting to get a little problematic. This is a whole new chapter.
Whole new chapter, and really glad we could get that in there. So thank you for stopping by, Liz Hoffman. Coming up, former President Donald Trump looking to cash in on his new line of NFTs, and Yahoo Finance bought one. We're going to show it to you after the break. Welcome back. The White House finally planning to replenish the SPR. That's the Strategic Petroleum Reserve. Biden administration ordering 3 million barrels of crude oil to be delivered in February. However, they have a ways to go before they fully replace the 180 million barrels that were released so far. Energy Department also announcing a nearly 2 million barrel crude oil exchange to relieve shortages at refineries after an oil spill last week shut down the Keystone crude pipeline. Oil futures closed today at $74.29, putting the price of crude well below the $96 a barrel the U.S. sold the oil for originally. And shares of Guardian Health fell, and those of its competitor Exact Sciences rallied on Thursday after a study showed that the latter's colorectal screening test to be more effective than Guardian's blood testing method. Yahoo Finance for senior reporter Anjali Khemlani has the details. Anj.
That's right, Jared. You hit the nail on the head at the very end. Number one key difference in the method of sample collection, right? You've got blood versus stool sampling. And we've also got a newcomer on the market versus sort of the guy, that's been in the ring for a while. We know that Guardant had barely missed what analysts were expecting. That 83% came in just shy of 85% sensitivity, which is what analysts were looking for. That compared to another player in the market, actually, which comes in at 60, in the 60s. So you can tell there's a lot of variation, even within apples to apples comparison to another blood company. But then Exact Sciences, really the market leader right now with Cologuard and having a different technology that they're using and a 92% sensitivity. So that's sort of where the bar has been set. And, Guardant didn't quite get there in terms of matching.
All right, Anjali Khemlani, thanks so much. Enjoy the weekend. Good to have you. All right, NFTs are back in the news, but this time it's non-fungible Trump. Yes, the former president now has his own line of NFTs, and our senior columnist, Rick Newman, actually bought one of these trading cards. Rick, before we get to you, I want to play this ad that somehow inspired you.
Hello, everyone. This is Donald Trump, hopefully your favorite president of all time, better than Lincoln, better than Washington, with an important announcement to make. I'm doing my first official Donald J. Trump NFT collection right here and right now. They're called Trump Digital Trading Cards. These cards feature some of the really incredible artwork pertaining to my life and my career. It's been very exciting.
Sorry.
Taking on Mount Rushmore.
Here's the thing, Rick. I don't know what Saturday Night Live is going to do with that. There is no way to improve upon that, man. You cannot make that funnier. It's like buying a movie theater in the spring of 2020. Which one did you buy and why? Why were you inspired by that ad?
When I saw what was going on here, and look, I'm no pioneer in NFTs, and I've been asking David Hollerith, our crypto reporter, to kind of guide me along. But when I saw what was happening here, I said, we got to buy one of these. So I slacked my editor and said, can I buy one of these on the Yahoo Finance corporate card? And she said, okay. And you won't believe it. I bought it for $99, and I just checked a couple moments ago. Today it was worth $182. So Yahoo Finance is making money off of Trump. Now you ask me which card did I buy? I did not get a choice. It did not ask me what type of card I bought. I could have missed that on the entry form somehow. I just was kind of blindly going along, and I got Trump, the baseball player. There you see him. I got Trump, the baseball player. He's got very large hands, I noticed. And as I've been going through looking at, I'm sure you guys have been looking at some of the other Trump cards. I like the ones with cowboy hats because Trump looks ridiculous. But it looks as if what they did is they sort of like took the body of Daniel Craig when he was playing James Bond, and they just photoshopped Trump's face and then a bunch of different hats onto it. But they are, I guess they are non-fungible tokens, NFTs, and there are 45,000 of them now.
Well, I got to tell you, I don't know where to begin either, Dave. Do I have a question for you, Rick? I don't really have a question. I mean, we did some mock-ups with our own computer CGI department here, and I don't know if they're NFTs or not, but came up with some pretty funny examples. I don't even know if we have them here to show you. Rick, what's the next step here for Trump raising money besides the fact that Yahoo Finance is bank? Oh, there's one. We do have these available.
This is real, Jared. I don't know what you're talking about.
Okay,
Rick, these are, Yahoo didn't just buy a Trump NFT. We are creating our own. There was mine. There is Jared's. Obviously, that's his real body. And then the big reveal.
Guys, what's your buy-in?
There's yours, Rick. There's yours.
My buy-in is 5 Doge.
So here's the thing. It doesn't, Rick, and you listen to that ad, which I have about 97 times, it does not sound as though Trump's heart is really in this. He literally says, you could have dinner with me if you think that's exciting. It doesn't appear that he's really into this, but maybe they're making money. What's your read on it? Good investment?
Well, I mean, I'm sure Trump is making money on this. There's no doubt. I mean, he gets the money right off the top because this is the standard Trump format, which is it's not his company. He licenses his name, and he gets a sweep right off the top for everything they sell. So I think this is money straight in the door for Trump, and I don't think it matters even if these things would go to zero in the secondary market. I think Trump has already gotten his money by then. But look, other prior presidents at this point, after they've been out of office, they're starting their libraries. Jimmy Carter was, doing work, with voting rights in a bunch of other countries. And some of them, I guess, were trying to plan for what their political future might be. Barack Obama was developing a Netflix program. Trump is hawking merchandise. That's what he does. He's a showman. And I guess he's always a showman. And I just can't imagine how this is going to morph into his 2024 presidential campaign. But I can't wait.
Well, I can tell you what, Digital World Acquisition Company is down like 9% today, so they don't apparently love it. Where do you rank it with Trump Water, Trump Vodka, Trump Airlines, and some of the true beauties?
Honestly, that's the reason I wanted to buy this. And my purpose is not to turn an $82 profit for Yahoo Finance. My purpose is just to follow this and see what happens. So some of those Trump come-ons were really outright scams, and some of them were just cheesy. So I think Trump Water was just cheesy. I think Trump University was a total con. And that's really what I'm looking for here. So I will be having a story about this at some point in the future. For the moment, I'm just enjoying myself, guys.
Me too. Can't wait for the story. I have nothing to add to this conversation.
Clearly.
I think we've done it thoroughly.
We noticed.
Yes, Yahoo Finance's Rick Newman. Thank you, as always.
Hi, guys.
Coming up, Ford raising the price of its F-150 Lightning truck again. We'll tell you why on the other side of this break.
The National Highway Traffic Safety Administration has opened a probe into GM's Cruise autonomous driving unit after a number of reports that vehicles crashing on the road. Yahoo Finance senior autos reporter Pras Romanian here with more on this story. What's going on?
You know, it's kind of another black eye for the self-driving industry here. You know, Cruise, GM's big autonomous division out in San Francisco. Apparently, a couple crashes here with cars that were inappropriately hard braking or becoming immobilized while operating. So basically, the car, like right here in motion, it comes across a hazard and it just stops and panics. And what happens is it becomes an object in traffic that's stuck there, and people have to get out in the middle of traffic, so it's problematic. So apparently there's three hard braking accidents with this, and a number of other incidents that we don't know about. GM says Cruise says they're complying with the investigation, and that they've done 700,000 autonomous miles with this system. So, you know, it's still happening. They want to try to expand their apparently right now they're in 30% of SF. They want to expand to 100%. So not exactly easy when you've got kind of some issues and a probe going into it. But I will say this, though. This comes after Ford pulled the plug on Argo AI, that their autonomous division. And then also you have Tesla still under investigation with NHTSA because of these crashes at accident scenes. So it's still, this technology is still very nascent.
Years and years away, isn't it?
I guess I can sleep well at night knowing that the default action, if we have an AI algorithm controlling a car rolling down the streets of San Francisco or whatever, it goes into panic mode and it just sits there.
Stops, yeah.
It just stops. Yeah. All right, well, on a slightly different note, we have the prices of the F-150 Lightning. Those are going up. Why? Why? What? And how high are they going?
Well, you know, as DJ Khaled said, another one.
Wow.
Sorry, had to do it. It's Friday, had to do it. Third price hike this year. You know, now that base price of that truck is $56,000 for that base Pro model. That's up 40% from the $39,000 they said it would come out with at launch. So, you know, it's kind of disconcerting if you're a Ford F-150 Lightning owned buyer and you're seeing that price creep up ever higher. But you know what? I think the thing is, you know, Ford says that they have to deal with part shortages, rising material costs, things like that. But my point is they have sold out. The order books are sold out. This truck is in high demand. They're increasing production next year. They can raise prices because they can at this point. And we're talking about, you know, it is $56,000 plus your federal tax credit. So, you know, it's still going to be relatively not that of a huge hit for you, but I can see why they're doing it.
Yeah, absolutely. Why not? Next time you drop DJ Khaled, I need a little more flavor. I need a little more oomph into it. More. Okay?
Another one.
Yeah. All right. Good stuff. Pras, thank you. Have a good weekend. Coming up, Meta catches a rare upgrade. We'll tell you why one analyst is bullish on the stock heading into the new year. Stick around.
Welcome back, and it's time now to take a look at some of the biggest stock movers of the week. And let me put this on a 5-day basis. I'm going to start with Tesla because of all the mega caps here, it is by far down the most, down 16%. By the way, that is its worst 1-week performance since March of 2020, and that would put it all the way back down here near the pandemic lows. It is up substantially more than that. However, you got to take a look at this top right here and wonder if that is a huge distribution top, because Elon Musk has been selling a lot of Tesla stock. That's one of the big headlines from this week. Now, you take a look at this 10-year chart. That is a different story, but let's dial it back down to a year-to-date chart, and you can see that it is camping out back down by those lows of the year. Also, as if there's not enough other news, we're also going to take a look in the Dow at Disney. Now, we got Avatar, Way of the Water, coming out this weekend. I think $17 million in pre-sales. That's chump change, right? Because this movie is supposed to bring in about $190 million over the weekend, and that's just getting started. I think the original Avatar of 2009 brought in something like almost $3 billion, or $3 billion. I'm getting my orders of magnitude mixed up here. So let's move on to the travel sector, where we got a little bit of disappointing news from some of the air carriers this week. JetBlue dialing back down some of its expectations for the fourth quarter. Also saw that out of Spirit Airlines, some of their key metrics undergoing a little bit of revision here. So December, not the best travel month it's looking like so far, and some of these airlines have been stumbling. Here's JetBlue, another stock that is down about over 50% year to date, camping out by its lows as well. Just want to get on to Spirit Airlines. I mentioned that as well. And you can see that's a little bit of a different picture here, some really choppy action, although it's in, I would say, the lower third of its price range for the year. Dave?
Spirit Airlines just adding routes between Charleston, South Carolina and Newark, New Jersey. $40. I just thought you might want to know
Thank
that.
you.
Big fan of Charleston, South Carolina, for those wondering. Here's what I'm watching for. Next week, we have a slew of economic data ahead. The week starts slow with the NAHB Home Builders Index being released Monday. Tuesday, we get building permits and housing starts, where we get another glimpse of a struggling market. Wednesday brings consumer confidence and existing home sales. Thursday, another read on third quarter GDP. We'll also get jobless claims and leading economic indicators. Friday, a big day. We get the PCE price index, consumer spending, consumer sentiment, and new home sales. Also, a number of companies reporting earnings next week as well. We'll get reads on the consumer from Nike, General Mills, CarMax, and Carnival Corp. A lot of eyes will also be on FedEx after their disastrous report last quarter. We'll also hear from memory maker Micron Technology, which has been getting hit by the weakness in PC sales. All in all, a lot going on in the week leading into a major holiday.
That major holiday being Christmas, by the way.
Thank you, buddy.
All right. Well, don't bury the lead. That's what I was taught. Meta stock moving lower after the close. You can see it's down about 31 basis points right there. That's from the stock getting an upgrade from JP Morgan analyst Doug Anmuth, saying that going into 2023, the tech giant is showing signs of cost discipline. And here to weigh in on this is Yahoo Finance tech reporter Dan Howley. Dan, do you think Meta could see a turnaround in 2023?
Yeah, they have been doing some cost controls. Obviously, they had laid off those 10,000 roughly employees, 11,000 between there. They are going ahead and cutting back on some of the real estate that they were going to be occupying in New York. There are some reports of that. So it does look like they are kind of trying to reduce spending overall. Whether or not that means that we'll see the ad market return in 2023 or in the next quarter or two even, that's kind of still up in the air. The ad market obviously really stinging any company that relies on it. Meta, though, just also dealing with the privacy issues that we had seen creep up from Apple and their changes to iOS. Now, in this note, it says that those changes may not be as harmful for Meta in the coming days, or in the coming months, rather, saying that they should see a slowing of the impact from that. Meta either starting to straighten out what it needs to, or kind of working in Apple's alternative to their prior kind of tracker technology that they had there. And there's also the idea that they could get better monetization out of Reels. Reels obviously being something of a TikTok competitor to them. So, we'll have to see if all of that shakes out. Look, it's got to be better than this year. I mean, I'm working on some of our best and worst performers of 2022. And oh, man, I mean, year to date, you're looking at this boy. It is quite a dog, down 63%. Look, I mean, that's as of, what was it, yesterday, the close of markets yesterday. So, I mean, nowhere but up, right?
Well, yeah, I mean, look, you're talking about $1 trillion market cap company down to what, $318 billion. It has been rough. I think the investors, beyond cost cuts, to your point, though, would like to hear about Reels or like to hear about, is the metaverse getting closer? But that is clearly not the case for now. What about those Apple privacy changes? Will that continue to hurt the company down the road?
Yeah, I mean, I think it's something that Meta just has to learn how to contend with. Apple's not going back, and that's part of, not the reason for, but part of why they're pushing so heavily into the metaverse. They don't want to be left out and have to rely on a company like Apple or anyone else when it comes to hardware to access their customers. Right now, to get onto Facebook or Instagram, chances are, you go on your iPhone or your Android phone. And they don't want to be beholden to a third party like that. So that's part of the reason for this huge push into the metaverse. Now, look, when big news comes out that characters or avatars are getting legs in the metaverse and that's supposed to be blowing us away, it's not really showing us that the metaverse is all it's cracked up to be. There's also been, not great reviews of its newest headset, which is also out of range for a lot of average consumers as far as price goes. So, we'll have to see how it continues to kind of push that market forward and if it'll be something that people actually want to dive into. But I say it again and again, people get eye surgery so they don't have to wear glasses. Making people wear something on their head for a long time, I don't know if that's going to, work out.
Dan the Man, very bullish on the Metasphere. Thank you, Dan. Enjoy the weekend. 2023 is around the corner and fast food chains are gearing up for what could be next. Here to break down a few trends we're keeping our eye on is Brooke DePalma. Brooke, what's coming?
Well, unfortunately, to start with, lackluster side of the news is higher menu prices are unfortunately here to stay, according to Wall Street analysts that I spoke with earlier this year. Of course, we've seen food away from home up 8.5% year over year, month over month up 0.5%. So it's not necessarily a decrease, but rather a deceleration here, leading to fast food giants like McDonald's, like Starbucks, perhaps taking more pricing in the new year. So bad news for consumers. But at the same time, it is a bit of a boost to the business. And just to reiterate that, Peter Saleh of BTIG emphasizing that you're going to continue to see some more pricing in 2023 as fast food giants, try and offset some of these inflationary pressures, which for the most part right now really haven't eased yet. And of course, if you take a deeper dive into the way that the consumers are responding, is we're continuing to take that price. And so these companies will keep giving it to us.
Yeah.
All right, Brooke. So, when we're talking about the adoption of digital, it's also a big investment. What we're seeing from fast food companies, we saw McDonald's get in this space a big way a few years ago. How about for next year? What kind of technology is coming?
Yeah, well, you can certainly hear from Wall Street and CEOs alike. Yum Brands CFO Christopher Turner saying just a few days ago at their Investor Day that he has aspirations that someday it'll be 100% of its sales powered by digital. That is a long-term goal, not necessarily in 2023, but companies like McDonald's, like Burger King, they're investing $400 million to accelerate their growth. Of course, they just named Executive Chairman Patrick Joel, the former CEO of Domino's Pizza, to come onto the board. So certainly making a big play here. But that overall digital market expected to grow at an annual rate of 17.25%. That's according to Precedent's research. But when you look at exactly how much of sales per company make up, we're seeing at Yum Brands $6 billion this recent quarter, exceeding 40% of its total sales. So certainly a big opportunities here, and customers certainly taking to those mobile apps and paying with their phones, something that we saw start during the pandemic and something we're expecting to still see in 2023.
Got to tell you, Brooke, I hate loading up my phones with apps, but I got a few in there. Chipotle is one. Hint, hint, guys, send me some offers. All right, Brooke, stay right here because first teaser for the upcoming Barbie movie is out today, and it zeroes in on the importance of dolls in society.
Since the beginning of time, since the first little girl ever existed, there have been dolls. But the dolls were always and forever baby dolls. Until...
All right, guys, you're going to have to wait until July to see the movie. Got to ask you, well, it's a little bit too early for pre-sales as well, but you're going to be lining up?
Ladies first.
I absolutely will be. I mean, this is exactly what I've been waiting for in a sense. I feel like you grow up with this Barbie genre. Now, of course, a bit older, here I am. And this is something that my friends I'll be going to see. And also, just in general, I feel like the hype is real.
I just don't know what to make of it because I can't tell, is this a serious look at Barbie? Is there something deeper or is it like a parody? And that trailer right there gives me further questions.
Which one would you go to?
I just can't tell what the tone, I don't know.
Yeah.
I can't tell what the tone of this film is going to be. Are we going there to laugh or to be moved? What is it?
I was moved by that trailer. I mean, maybe you weren't?
Either way.
I had some sort of emotion.
I have an exegetical reading of the script will actually reveal a depth of character never before seen in a Hollywood.
I actually appreciate that. That's a good insight.
Okay.
It is Greta Gerwig, so I do think it's going to be a serious film. And either way, we're going to see it. It's like just so fascinating. All right, but if you're still gift shopping for the holidays, consider a $1,000 American Girl luxury dollhouse. This dollhouse, built for, of course, 18-inch dolls, includes a hot tub and a shower that makes water sounds and changes color as the temperature changes. The toy will run actually $600, but folks, that's just the base model. You're gonna go well north of $1,000 with all the add-ons here. Look, Brooke, this is like the Mac Daddy of dollhouses. It used to be the Barbie Dream House. Move over, Barbie Dream House. Now it's this, would you go for the $1,000 American Girl?
As much as I would absolutely love to have this American Girl dollhouse, I mean, the price tag is certainly for someone who has a high income here. I mean, you could flip through the American Girl doll playbook and gift guide for hours just looking at these high ticket items to invest and give to your American Girl doll. But American Girl dolls, at least when I was growing up, it was really an investment here. Now, as far as these investment, meaning, Dave, you have it. And frankly, I still have all mine in my attic because they're going to be worth money one day.
Okay, you mean an investment that's actually going to appreciate?
I believe so. I mean, I still have Molly, my American Girl doll. As far as this dollhouse goes, 1,000 ticket item, sure, fun for a few years, maybe pass it along to a friend. But it's definitely, when you think of the audience of American Girl dolls, I believe it's actually expanding their near Times Square location, actually gaining attraction from Gen Z, young millennials, to go to that cafe. So maybe people will buy this 1,000 ticket
They've got
item.
like a hospital, they've got a salon. I've been there, it's fantastic. I've got thousands of dollars of American Girl stuff in my attic as well. Brooke De Palma, good to see you. Thanks so much, great stuff.
Coming up, guys, a real Christmas tree, but don't want one to cut down? You could always rent one. We're going to tell you how and what that's all about up next.
Well, we're closing in on the Christmas holiday, and if you have not bought your tree yet, you might want to consider renting one. Our next guest runs a Christmas tree rental business in Central California. The trees live in a forest nursery, and when the holidays roll around, the company will deliver the potted tree to your home and pick it up at the end of the holiday. At that point, the tree returns to the forest nursery. Joining us now is Monica Hudson, Rent-A-Living Christmas tree owner and operator. Nice to see you, Monica. Why did you get this idea? How does this work?
Well, first to the idea, in 2008, I saw a nurseryman in England loaning trees out that he didn't sell before Christmas, and that gave me the idea. And as far as it working, you mentioned earlier, we do grow these trees here on our farm in Carmel, California. We deliver them to the customers. Most of the customers order online. And then the rental is for 30 days. And at the end of that period, maximum 30 days, we come back and bring the tree home to our farm where they join the birds that nest in it and become part of the environment here and live to see another Christmas, very often in the same home.
And Monica, I'm wondering about the logistics here, specifically the roots, arguably one of the most important parts of the tree. Do you have a whole root system that has to follow the tree indoors each year? Are you able to trim it a little bit? Just wondering how that works.
Yeah, that's a really good question. The only way that's really possible is to have the tree live in a pot. And as you mentioned, the root system is important. As the tree grows, so does the pot. And the men here have a monumentous job of potting, especially the larger trees.
Well, Christmas tree inflation is through the roof. They're more than 10% more expensive than they were last year, so this makes a lot of sense, Monica. How much do they cost, and how important to the concept is sustainability?
Right. If you compare our trees to a private commercial lot, the trees run about the same, maybe slightly higher. However, it does depend what type of tree you select. We have cedars, firs, as well as California redwoods. And if you're settling for maybe an 8-foot tree, like the baby I have here beside me, that runs around $40 to $50 for the 30 days. If you go for an 8-foot Nordman fir that we have over on this side, that can be around $250 or so. And the firs are on the higher side because they're harder to maintain. They don't like living in a pot. Redwoods are native, and they're really something that we are introducing into the market because they're native and because they have a very good chance to have a life after they are a Christmas tree.
Monica, how do you assure that they're properly taken care of? And what if they come back having not been adequately fed?
Well, you know, when you order something, there is always the small print. It's called an agreement that nobody reads. And in there it says that you promise to use LED lights, no hot lights permitted, that you don't leave it by a heater or a fireplace, that you must water it every day, and we send it along with instructions just how much. We give a large saucer with it that gets installed under it so you don't have a problem with it leaking all over your floor. And if the tree comes back damaged, that is a damage assessment, and that's all spelled out in the agreement.
It's all in the fine print. Monica Hudson, Merry Christmas to you. It is Rent-A-Living Christmas Tree. We appreciate your time. Merry Christmas. All right, Jared, what do you think of this concept? I am all in. I figure if I'm going to spend $150, which my family did, I might as well have something that's sustainable and is going to get another life out of it. I don't mind the pot at all. I think it's a really cool concept.
Not only that, I only have room for about a 3 to 4 foot tree, and they actually sell those, quite a few of them down in Manhattan. It's not the greatest sight to see when you're used to the 7 foot tall ones, but I would definitely do this, and especially since it's on a rental basis, and I wouldn't have to worry about that tree not growing up into a bigger tree and ending up in somebody's larger living room.
Exactly. I love this. All right, good for Monica. That'll do it for us on Yahoo Finance Live. Jared, appreciate you filling in for Shauna. We'll be back here Monday, 3 o'clock Eastern Time with coverage leading up to and after the closing bell. Have a wonderful weekend.